Hello, and welcome to our How Agencies Create Value for an Acquisition webinar. I'm your host today, Alex Weaver, Vice President of Strategic Markets at Oak Street Funding. And joining me today is Brian McNeely, CFO and Partner at Reagan Consulting, and Alicia Chandler, President of Oak Street Funding. Today we'll be discussing how buyers define value early on, the most common areas agencies overlook, and why factors like leadership, culture, and financial transparency matter in the valuation process. Thank you, Brian and Alicia, for being here today.
Thank you for having us.
Yeah, thank you. Thank you for having us.
Yeah, Brian, so to start us off, how do buyers typically define value during the early stages of the acquisition process?
Yeah. Just before I get started, I want to just say thank you, but want to reiterate our Reagan's thanks to the Oak Street team and their partnership with us on the best practices work and being just a great partner in other parts of the industry as well. So thank you for having us and thank you for that partnership. And good afternoon, everybody. Hope everybody's got a fun weekend in front of them. So Alex, your question was around how do acquirers look at value, or how do they define value in the early stages? And it's actually a fairly simple. When I reach out to a prospective buyer to describe a client that's going to market to them, their first question always is, what's their organic growth? Organic growth and profitability, as we all know, are the drivers of value. But at the end of the day, the buyers are ultimately judged on their organic growth. You can see that play out in the public markets every day, and we've certainly seen it over the past month or so as they've dealt with the impacts of the softening market and how that's impacted their organic growth. But organic growth would be by and far the number one thing they want to hear about first and foremost.
Gotcha.
And to just, continue on just a little bit, I think today's strategic buyers are, they're really digging in, I think, a lot more than they did in the past. That's, as Brian said, it's not just about the profitability anymore. It's, they're looking at sustainability, scalability, they're looking at that organic growth, and they're being very selective about, I think, what they're looking for these days.
Yeah, and I would even go, Alicia, just break that down a little more. Is we're starting to see more and more, especially as the market has softened some, buyers want to understand the organic growth, but then they want to understand what's driving that organic growth. So how much of that is rate? How much of that is new business? How much of that is expansion of existing clients? So they're even getting more granular to try to understand the components of the organic growth. And that has proven challenging, or is challenging for a number of our clients, just because some of the systems don't make that very easy to track. But they're definitely even going a layer deeper than just straight up organic growth and going to the drivers of that.
Yeah, no, I think that definitely makes sense. And kind of to piggyback off of that, because obviously, profitability and organic growth are what most people are focusing on. What do sellers most commonly overlook, Alicia, when they're in these acquisition early discussions?
I think when somebody's looking to sell, there's a couple things that I think are, I'll say, easily overlooked when, you've been just running your business for all these years. I think there's things like, just looking at the management team, are the relationships really centered around just the owner or one producer? So I think there needs to be some, look at concentration among producers. Also, I think people need to make sure they're looking at concentration of their client base, of their carrier base. So on top of the things we just talked about with organic growth, they need to go that level deeper. They really need to look at, I think, where everything is held. And if it's held by the owner, they really need to start diversifying and making sure that, their management team is built out. I think some of the other stuff that the sellers overlook sometimes is going to be just the culture in general. And that's something that, maybe isn't on their day-to-day list, but just really thinking through their culture and how, that's going to transition on to the next generation as well.
Yeah, I mean, I would add just a little bit more to that, and I think all those are certainly valid points, and I would just put a little different spin on it in that nobody's agency is perfect. I like to tell clients everybody has some really good attributes, and everybody has some warts and some issues that they deal with. So in an acquisition process, you're going to have to explain those warts or those issues. So I always tell people where those issues exist, you need to be able to articulately explain the why and put the data behind it to help folks understand the why behind the way something is and might not be exactly as it's expected.
Yeah, to that point, Brian, and I know you guys spend a lot of time with clients on this as well, is just having a solid understanding of their financials, making sure that they're well prepared, and that, to your point, that they're defensible. If there are some blips, they need to be able to explain those and just really put the why behind those.
Yeah, for sure.
So going off of that, Brian, how early should agencies really begin preparing for these potential acquisitions?
So I don't think that there is a time that like some magic date where you put a stick in the sand and say, this is when we're going to start getting ready to sell the business or be acquired. I typically encourage clients, and even those clients that are looking to remain independent, to run your business like you're going to sell it tomorrow. Because the fact of the matter is, most likely, or the fact of the matter is that whatever you do that is going to allow you to stay independent or keep growing your business is something that's going to be favorably viewed by an acquirer. So if we're on a path to train, hire new young producers, that's going to be very attractive to an acquirer. We shouldn't cut that back because we think we're going to be acquired. So I just encourage people to run their business like they're going to sell it tomorrow and run it with an eye toward that organic growth and profitability.
Yeah. And I agree. I think one of the most common things we see, unfortunately, is just that failure to do what Brian said, is running it like you're going to sell it tomorrow. And I think a lot of times, that's when someone like Reagan comes into play. They can advise these clients on what steps they need to take to make sure that organic growth, profitability, all those things are top of mind as they continue to operate their business going forward.
And I think, one common mistake we see folks make is they try to do a whole lot of things and lose sight of the core mission, which is to grow the insurance revenues of the business and remain profitable. So I'll give you an example. We often have clients that buy real estate and they become bogged down in managing the real estate and how we're going to deal with that in a transaction. And that's fine. And there's reasons to do that. But at the end of the day, are you in the insurance brokerage business or are you in the real estate business? Let's major on the majors and focus on the things that you're really good at. And those other things are nice add-ons, but no, those things are going to be more distractions than add value for you.
Yeah, no, I think that makes a lot of sense as someone that, I talk to agency owners all day, and a lot of times they do try to, differentiate a little bit too much sometimes and don't focus on the big rocks in many of those cases. So, Alicia, in terms of those operation strategical changes, what do you think tends to add the most value ahead of those deals?
I know we're going to keep beating this drum, but I think it's sustainable organic growth. So, as Brian was talking about, that's certainly the top of mind of buyer these days. And so it really they need to be able to demonstrate that it is sustainable. And that involves, being able to track it and report on it. Do their systems actually do that? Is that something that they're able to do? And tracking that weekly and making sure that they are having those conversations with their producers, because it's not, obviously it's not just the owner's responsibility, it's everybody's responsibility. So they need to cascade those goals and make sure that's a part of their producers' compensation plans, on how they're compensated, whether it's a quarterly basis or an annual basis. I think it's looking at things like, can they add cross-selling? Is there a niche market that they can get into? Whether it's product specific, geographically specific, or demographically specific. So, I think those are all things that certainly can help as they go along.
Yeah, and the tag team back on, or tag to one of the earlier questions, when should they start preparing for an acquisition? I think this fits right in there, and I'll use the example of specialization. And Alicia, you mentioned this. We think specialization is going to be the key to prosperity in the future for the industry. So developing those specialties and having those specialties that are scalable and grow into the future, to Alicia's point, that are that are sustainable, that you can show have growth projections in the future. That's incredibly important. Along with that, another topic, which is just operational excellence. Just, are you operating the business most effectively? And lastly, producer recruiting and development. Critical component. Folks try to skimp by, but at the end of the day, whether you continue independently or continue as part of another firm, the key to your success is going to be that talent into the future.
Yeah, top talent is certainly something that I think people are afraid to focus on sometime because they don't want to spend the money, but they need to make sure that, again, that growth is sustainable, and you can only do that by bringing in top talent to add on to what you already have. I think one of the other things that we actually see, and I know we focus on as well, is just diversifying the risk. So, making sure that your revenue streams are diversified, whether that's among clients or carriers and producers. So certainly diversifying that risk is something else that I think is really important.
Yeah, and to the specialty point, specialties are good, but if you have all your eggs in one basket, that's not great either. So if the specialty is really growing, it's probably going to have a downturn in the future. So hopefully you have something to offset that, another specialty perhaps.
Yeah, that makes a lot of sense. And it looks like we got a live question from one of our viewers. Does it matter how that organic growth is obtained, whether it's advertising or through other methods?
No, I don't. No, I mean, organic growth, however you get it, it shows up on the P&L, right? So if that's a function of producers selling more, you're advertising and getting more leads in the door that way, I think as long as you have if you're putting it on the books, it's good business, and especially if it's a sustained pattern of that, whatever efforts you're using doing that.
Gotcha. And then Brian, kind of going off an earlier question, how do culture, leadership, and talent retention really influence that value prior to an acquisition?
Yeah, I mean, at the end of the day, the brokerage business, the assets go home every day, right? And the first thing, or not the first thing, but when buyers are doing their due diligence, they are incredibly keen and have a sharp eye towards the talent, what that talent's wants to do in the future. Do they want to stick around? What are their aspirations for the future? Because most of the acquirers in the market don't have a lot of talent running around that they can plug in or come help you fix your organization, or can come in and run your organization. They need folks within the existing business to take that and ideally take on broader leadership roles. So, it's a people business. So without people, the brokerages tend to flounder. So it is the number one, it's the most critical issue in the brokerage industry.
Yeah, just to follow on to that, I think there is I'll say, a battle over good talent for the issues that you just mentioned. And buyers certainly want to make sure they understand, who those key players are in the business and retain them, because obviously retaining them will retain those intangible assets that are the reason for the acquisition in the first place. So I think focusing on those key employees and really understanding what their goals are, and are they aligned with the buyer? Do they want to step up, like you said, Brian, into that leadership position, and maybe take on some roles in the buyer's organization itself?
Yeah, Alicia, you hit on a big topic right now, and that's securing the talent. There's a lot of, we'll term it poaching of talent in the industry going on. Some done not necessarily the best way to do it, or I'll say it a more blunt way. People are stealing talent and violating restrictive agreements. That's not a good look for our industry. That's not a good thing to be happening for the values in the industry. So there is more emphasis being placed on by the buyers of, okay, here's the talent, we like it, but and we think that there's future growth opportunities for these folks. But first and foremost, how can we lock them up and ensure that they are secured employees of ours for the foreseeable future, or at least under some contract terms? Because without a doubt, you can pick up the newspaper, you can look at the headlines of the journals in the industry, and there's lawsuits being filed every day by talent being taken and stealing business. So that is probably the number one topic right now, and it's always been an issue, but it's just given the number of instances that have happened recently, it's become even a bigger topic.
Yeah, and Brian, that's I mean, as the lender, when we're looking at acquisition financing for some of our borrowers, that's certainly something we pay really deep attention to, and get in there and really want to understand what that's, what the buyer or the seller, I'm sorry, what the seller looks like and what those teams look like, and making sure, like you said, that there's alignment with that team moving forward so that those assets don't walk out the door.
Yep, for sure.
Yeah. And then so, kind of piggybacking off of that, why does scalability play such an important role for the pre-acquisition process and kind of, helping to determine those multiples?
The acquirers in the market, as we've mentioned several times, are judged, and their ultimate objective is organic growth. So they want to acquire a company or a broker that has demonstrated organic growth, but one that they can plug into their resources, tools, and infrastructure and turbocharge that growth. They don't have the bandwidth nor the desire to come in and rebuild an organization, rehabilitate an organization. That's not what they're looking for. They want to plug and play and turbocharge growth.
Yeah, they want to, make sure that, they're able to grow without having to incur those additional expenses. And, that just gives them more profit. So certainly something that plays a huge role in the acquisition process.
Yeah, exactly. And that's definitely going to drive, a better purchase price if you can just kind of plug and play it into your own systems versus having to kind of, like you said, do a lot of legwork to, get them up and running how you're already running your business.
Right. I mean, if there's someone that's running a lifestyle agency and they're just kind of riding on the renewals and not really focused on organic growth or scalability of the business, they're certainly not going to get, I think, the multiple that someone that's focused on that is going to.
And I think the acquirers would tell you that what they hope for is that they learn something from the folks they're acquiring to make them better. They don't think they've got it all figured out. And if they partner with somebody and those folks are doing something better and helps them scale their business better or become more profitable or grow faster, gosh, they want to grab a hold of that and exploit it as much as they can.
And then Alicia, so a little bit obviously from the lender side as well, but how do buyers really evaluate client concentration and the overall revenue quality that they're looking at before a deal?
Yeah, it's a great question. And as a lender, we pay a lot of attention to that as well, just as any buyer would. We're going to look at the agency or the broker's top 5 clients, top 10 clients, what percentage of the revenue do they make up? And if it's going to be more than, 10% of the revenue, we're going to start asking questions about that client. What happens if they leave? What kind of impact is that going to have on their bottom line? Because that could ultimately have an impact on their ability to repay the loan. And to further that, you can go into carrier concentration, as we talked about a little bit earlier with specialties and things. But, if you're with a carrier and you do 70% of your business and that carrier either doesn't offer your product anymore or something happens and you get sideways with that carrier, if they are out of the picture, where are you going to write that business and what impact is that going to have on your client base? And then I think the other piece along with that is just looking at the business or the revenue itself, the quality of it. Is it reoccurring? Is it transactional? Is there a heavy dependence on annual bonuses or earnouts from carriers? And if there's a very high dependence on those one-time annual payments, what happens if they don't hit those metrics and they don't get that annual bonus? What impact does that have on their cash flow throughout the rest of the year and their ability to service their debt, whether it's just the lender's debt, whether it's a combination of the lender and seller debt? Those are all things I think are very important in terms of looking at the concentration and the revenue mix.
Yeah, and I think people need to understand, I'll hit on the customer concentration specifically, the economic impacts of a loss of a large account. It's not that you lose, let's say you lose a $100,000 account and it goes out the door and the producer commissions go away, but that's about it. So you didn't lose $20,000 in profits. You probably lost $60,000 in profits because you lost the producer commissions, but most of the rest of your costs are fixed. So losses of large concentrated accounts creates bigger holes in the profitability that are hard to certainly overcome in the short term.
Yeah, no, and I think piggybacking off what Alicia said, those bonuses and that carrier concentration, you can see a carrier change their commissions 2%, and it's immediately hitting your bottom line pretty significantly if you have a very, very high concentration with that single carrier. And so, Brian, what do you see are the most common mistakes that agencies make when they're trying to position themselves for an eventual sale?
I think more often than not, and I think some of this is human nature, is they wait too long. Oftentimes you can see 4 or 5 years out, we haven't done the recruiting we needed to do. We haven't expanded like we should, whether that be geographically or product wise. We haven't developed the tools and resources we need. We're starting to lose accounts or not be competitive on certain accounts based on the resources we have. And by that point, it's a little too late. It's not totally too late. It's just a little too late because the business has already started declining or you're having issues, versus if you'd done it earlier, you could have already plugged into those tools and resources of the acquirer and already be on your way.
Yeah, I think the failure to plan, not only with adequate time, but just the tools and resources to continue to grow and get you to the next stage. We see that all the time. I know, as Brian does, you see someone that, someone passed away. The owner or one of the owners passes away and they think, oh, we need to work with the estate or we need to figure out what to do with the business. Obviously, by that time, it's too late. And so certainly preparing and getting the right people in place to help you get there is what you need to do. And it's just unfortunate that there is that failure to plan as a consistent theme that we see, unfortunately.
Yeah, and I feel like we've seen it improve a little bit because I think there's been enough horror stories that have kind of come through of people not being prepared for it. That the industry is moving a little bit more towards kind of being forward thinking, but it's still definitely
Plan for the worst and hope for the best.
exactly. So, what's an example of something that maybe went undisclosed in a deal, Brian, that kind of came out of the woodwork as you were kind of more in the thick of the deal?
Yeah, I mean, I would encourage people, if they're secrets or you think you can hide things through the entire diligence process of an acquisition, you're fooling yourself. There's lots of unfortunate stories out there. There's one where, you're getting 2 weeks before closing and people are doing background checks and it comes out that, one of the principals of the broker has a felony on their record. That's probably something that the buyers are going to be interested in. That's probably something they care about understanding, and having that surprise thrown on them at the 11th hour is just not great. But oftentimes people think things they can slip them under the rug or they won't be found out. And it's just actually the opposite. I tell folks when they think about due diligence, the acquirers are going to come in and turn over every rock, want to see every contract and try to see everything you've ever done for the history of your organization. So just know that's coming and be truthful and upfront, because it's going to come out. And if you try to hide it, that's a problem, both from dealing with the issue and the fact you tried to hide it.
Yeah, I think, we also have those same concerns and see those things as a lender. We're a last minute, we see a tax lien that's been filed that they didn't disclose, a judgment for maybe whether it's a client issue or prior producer that's, they're suing or as suing them for taking business. And so failure to disclose those things early in the process, it really starts to make people question, are they being untruthful about something else, or is there something else out there that we're not seeing? And so it really puts everybody, I think the hair on the neck starts standing up, and then they really start digging in and really asking even more questions at that point.
Yeah, and with all that said, there's always things that pop up that you forgot about, or you're like, that's not going to be an issue. So, and it becomes a bigger issue than it is. And those are understandable. You can work through them. It's the ones that you're actively trying to not disclose, and hopefully they won't be noticed, that are the problems.
Yeah, and so when it comes to, a seller preparing for their sale, how important is that quality of data and their reporting and their financial transparency in terms of, really building that buyer's confidence early on in the acquisition process?
This is a little bit of a soapbox for me. I think it is for Alicia too. Is for whatever reason, this industry has underinvested in financial acumen and resources over the years. I think a part of that is the business is not difficult. It just generates a lot of cash flow. It generates very healthy margins, and people are making a lot of money. So it's like, what do I'm making enough money. I don't need to know anymore. How do you know? But the devil's in the details, especially as you get bigger. I think one of the challenges that we see is as firms hit different stages of growth, they have to change who they are. When you're a $5 million firm and you've grown to 15, that's a different animal. You're now a fully functioning large organization, and you need the financial resources and acumen in your business to do that. I was speaking with a client yesterday, and he was actually roughly $20 million in revenue, and he's thinking he's going to take a step back in his financial resources. And, I told him he needs to be thinking about spending 1% of revenue on a finance leader, that you need to be investing in that kind of quality financial acumen and financial expertise to run your business most effectively. So,
Yeah, I think
200 grand of, invested in a finance leader. And people, that scares people to death, but it will more than pay for itself.
it will. I think to your point, Brian, oftentimes we'll see someone and, maybe they have the same bookkeeper they've had since they were, I'll say, a single producer, just out on their own to where they are now. And they need to step up to a CFO or even retain a fractional CFO. They need to update their financials to be, prepared by an outside accounting firm rather than just internally prepared. And, I think it really shows for us as a lender, it really shows when we start having the discussions about financial covenants and how they're tracked and what we're looking for and the ability to produce sound and reliable financials on an ongoing basis. And so certainly those are things that we see a lot of, as you indicated, when we're going through the process. And it's certainly worth the money, well worth it in the long run.
Yeah, everybody in the acquisition process wants to have a keen understanding of the details of the financial case that's part of the acquisition, and there's no way around that.
Yeah. And so obviously outside of contacting Brian and Reagan, what do we think is kind of the biggest single improvement that someone can meaningfully make in about the 12 or 24 months leading up to an acquisition that can kind of set themselves up for the most success?
So, I think as we've talked already a bunch, it's just that organic growth. It's really focusing on it. And then it's going to be making sure that you're bringing in the right talent to help with that organic growth.
Yeah, run the business for who you want to be, not who you are.
Yeah, so that kind of wraps up our baseline questions. We have a few submitted questions that we'll go through just to give us kind of a few different perspectives. So, our next question is from Christine, who asks, what is the market like out there for insurance agencies purchasing or brokering?
It's still frothy. You see what's happened in the public markets, and the public brokers have certainly taken some pretty good hits over the past month or so, and people question whether that's going to impact M&A pricing. We to date have not seen that. And a lot of that is driven by, we think the economy is going to be pretty good this year. So that's going to give the industry some tailwinds, but more importantly, a lot of the pricing in the market, the attractiveness, the continued appetite for acquisitions is simply driven by the basic economic principles of supply and demand. There are roughly 48 active buyers in the market at different levels of activity, but we would consider those active buyers doing 5 or more acquisitions a year. So, regardless of what's going on in the world around them, and that will always have an impact, at the end of the day, a lot of those businesses have built their thesis and built their returns and sold to their shareholders a business model where they're doing acquisitions. So they have to keep doing acquisitions, and there's where the supply and demand comes into play.
Yeah, no, we're continuing to again hear the same thing, that it continues to be a frothy market. I think one of the things we've noticed, however, is that not a lot of the sales are being advertised anymore for probably a lot of the reasons we talked about with poaching and things of that nature. So they're continuing to happen. We're just not hearing about them probably as much as we were in the past.
Yeah, I mean, and that's something else, Alicia. Good point. I mean, people are pointing to, well, the deal numbers are down. Well, I'm not sure the deal numbers are down on, to your point, on an actual basis. The reported numbers are down because people aren't reporting them. Or they, and some folks have had a practice of doing that all along. But from our perspective, and you can even look at some data that we looked at recently, is pricing was actually up a little bit last year in 2025 versus 2024.
Yeah, I think that's something that we're seeing in a pretty common state as well. And so another question we got from Greg was, at what EBITDA level or revenue are we really seeing those break points in the valuation multiples for acquisitions?
I mean, certainly there. I don't know. There's a specific number I would go point to, but there's certainly value in size. And for a couple of reasons, you can scale those businesses more. You can grow those. You can plug more into those larger businesses. Folks, a lot of the acquirers in the market would rather do one $25 million acquisition than 10 $2.5 million acquisitions, just because there's a fixed amount of work that goes into an acquisition regardless of the size. But, I'd say anything above 10 million now in revenue, it gets attention. That's a larger agency that's on the market, just because that's on the larger end of what's available right now. But I think what's more interesting is the other end of the market. $1 million, $2 million, $2.5 million. Those size agencies used to get a muted response from a lot of the acquirers in the market, and now everybody wants to hear what that opportunity looks like. Again, going back to the supply and demand, they need to do acquisitions. So they're willing to look at all size categories. There's no discrimination purely based on size anymore.
Great. Then we have another question from Garak, who asked, how do you work financing in conjunction with a bank loan? Owner financing, sorry, in conjunction with a bank loan from someone like that.
Yeah, excuse me. So that's a great question, and we get that question a lot. So, with respect to if we have an acquisition situation, regardless of the multiple or the purchase price, as a lender, we can only lend up to a certain leverage, that service coverage ratio. And so we will look for the seller to make up that difference, and the buyer too, as well, perhaps sometimes, depending on the facts. But that would be owner financing with some, an earn out or a seller note based upon a specific dollar amount. And that amount would have to be subordinated to the lender's note, which, every lender is going to require a subordination of a seller earn out or a seller note. I think the key to it, in addition to just the financial aspect, is just the alignment. I think a seller note or an earnout certainly makes that seller aligned with the buyer moving forward and makes sure that they're doing the right things. I think oftentimes it's an additional incentive for the seller when it's an earnout and it's based on maybe additional growth or referring opportunities to the buyer. So for a lot of reasons, we want to see a seller note or seller earnout of some shape. And we also obviously will make sure it's subordinated, but I think it also sets the right tone and makes the acquisition a lot more aligned moving forward.
Yeah, an acquisition, the value of an acquisition where the owners and key contributors are going to stay around is materially higher than somebody's that's going to throw you the keys and head to the beach. We go back to, it's a people business, but the values to having people bought in and being part of it, that creates additional value.
Yeah, and I think that kind of piggybacks off of, what we talked about with value, where you're going to get a lot more out of it if you're aligned with the buyer, because, they're willing to kind of pay a higher multiple to keep you around, to make sure that that business stays where it was when they bought it.
Yep.
Yeah. And a lot of times now, and I know you're probably seeing this too, Brian, as we see the sellers taking an equity stake in the buyer. which to us is evidence of true alignment. You're buying into that in addition to what you're selling. So really like to see those kind of situations.
And it doesn't always work out, but I can tell you there are numerous times where the sellers have gone on to take leadership and positions at a pretty good high level after they've been acquired within the folks they were acquired by. So that the acquirer essentially earns their trust, and the seller doubles down and wants to stay in the business and wants to help grow that business. That's kind of the ultimate win for everybody.
Mm-hmm.
Yeah, well, I want to thank you both for being here today and sharing all these really important insights with our audience. And thank you to those who tuned in and submitted questions today as well. We're happy to provide all that extra information, and we appreciate your continued viewership. So stay tuned for more from us here at Oak Street Funding with new content and new guests. Thanks again.
Thank you. Have a great weekend.